Joining us now is the economist behind that call, David Mericle. He is chief U.S. economist with Goldman Sachs. And, of course, CNBC senior economics reporter Steve Liesman as well. Steve, I honestly, you know me, never at a loss for words, but I think I am this time. I don't know where to start with you because everybody's focused on rates, and I get that. But with the job market showing some cracks, with commercial real estate maybe in the banks showing some cracks, could the Fed focus also shift a little more toward the other side of their twin obligations, and that is jobs?
Yeah, I think that's a good question, Brian, and I think it may be starting to, but I think it needs, just like it needs a little more data to be confident to cut rates, it's going to need a little more data of weak job growth in order to make that call. You still have relatively low jobless claims. You still have relatively low, but it's higher continuing claims. The ADP signaled somewhat weaker employment growth, as did the ISM this morning. I think if there's a couple months of weaker job growth, the Fed may increasingly put its focus there. It could speed up the timetable a bit, but I think the data has to be pretty bad for that to happen.
Yeah, and David, do you expect we will get that kind of, to Steve's point, quote unquote, bad data and see that shift focus from inflation to maximizing employment?
Not in the near term. I think for now, Chair Powell indicated that there's a pretty high bar for the inflation data to give them the confidence that they want in order to cut by the March meeting. So we push back our base case forecast from March to May. More broadly, though, I think you're right that any sign of something going wrong or something looking concerning could get them to cut a little bit more quickly. That's why we kept 5 cuts in the forecast for this year. I think there are a lot of scenarios that when you're starting off with a funds rate at 5 3/8 and inflation has been trending reasonably close to 2, the labor market looks rebalanced, a lot of scenarios could get you to say, we don't need to be this high. We can cut a little bit more quickly. Could be a growth scare. Could be labor market data looking a little bit more mixed. I think on average, the labor market data are strong, basically comparable to where we were pre-pandemic. That's the perfect place to be.
Yeah.
But there have been some conflicting signals. Could be inflation slowing too much for their liking as well.
Inflation slowing too much. I guess you get my point, Steve, because we've been so laser and hyper focused on inflation for the last 3 years, with, by the way, good reason. It looks like the inflation fight may have been won, looking that way, certainly for the data. Whether we get a big turn back up, we'll wait and see. And I just wonder, seeing what we're seeing at a UPS, 12,000 layoffs, a lot of tech stuff coming, the cracks in commercial real estate and banks. You know the Fed very well. You know them personally. Do you think they're going to have to start to talk about the other things that we really just, because jobs have been strong for 3 years?
Well, you know what they say, Brian, it's all good things in all good time. We've had a really good and strong run of jobs. It's not entirely clear that we are at balance. I would be watching the wage data most specifically. I'm not really sure that you can be too strong when it comes to the number of jobs. It's the inflationary pressure from the job market that would concern Powell and company over there. And on the downside, I think that you could have a period of time where you had either 100,000 or even below that, and that wouldn't be seen as abnormal. Remember, Brian, the unemployment rate is just 3.7%. As David says, a couple quick higher numbers, if that happened, would get the Fed's attention. But again, they're saying the risks are more balanced, but they're not quite saying that the risks are balanced. So they're not where you are, Brian, right now in terms of their abiding concern about the job market yet.
David, do you have any concern that inflation could reflare? I mean, we've had this before in history, right? In the late 70s, early 80s, been times where you think inflation's killed, then it kind of in the 70s, rears its ugly head again. Is there any chance, anything in your models that suggests that inflation could come back?
I think in order for that to happen in a big way, you would need some large external shock that none of us are going to guess today. Inflation expectations are back to a level that's compatible with 2%. The labor market has been rebalanced from an initial state of overheating back to conditions comparable to where we were pre-pandemic, when we had, if anything, a low rather than a high inflation problem. So this starting point, I think, is a very healthy one. A moderate increase in oil prices, a little bit of a further dip in the unemployment rate, that's not going to get you into serious trouble. You need some big shock coming along. So I think the inflation fight is basically won at this point. We have re-anchored inflation expectations. We have rebalanced the labor market.